Welcome to Business Recipe. Every business has a recipe. Here's theirs. Today's recipe: the two words the government uses when yes isn't actually true. In February 2022, Jelena McWilliams stepped down as the 21st chair of the FDIC, the agency whose entire job is telling you clearly whether your money is safe. 2 years later, she went looking for $85 million that depositors had been promised, in writing, was protected exactly that way. It's still not entirely clear where it went. That $85 million had a face. Kayla Morris sold her house in 2022, 15 years of savings, $280,000, into an account marketed as safe as any bank. She has recovered $500. Here's the recipe: the ingredients that built a system nobody fully owned. The method that made one company the only witness to your money, and a result even a federal judge couldn't fully explain. Also, you can see who's left at the table when the check arrives, and nobody ordered. Sanchayat Pathak came to the United States from India to study engineering at the University of Memphis. As an immigrant with no credit history, he couldn't open a bank account without showing up in person, in a suit and hoping. That frustration became a business plan. In April 2014, Pathak and a University of Memphis classmate, Brian Keltner, founded Synapse Financial Technologies. The pitch: banks are slow, apps are fast, so build the pipes between them. Andreessen Horowitz liked it enough to lead a $33 million round in 2019, on top of earlier funding. $50 million total, betting Synapse would become infrastructure other companies couldn't build themselves. By the early 2020s, Synapse's technology touched deposits for more than 10 million end users across more than 100 Fintech apps. Yada, Juno, Copper, and others you've probably used without knowing Synapse existed. None of those apps were banks. None of them could legally hold your deposit. So Synapse routed your money into partner banks, small obscure institutions like Evolve Bank and Trust in West Memphis, Arkansas, and Lineage Bank in Tennessee. Banks that were federally insured. That's the sales pitch. Your app talking to a real bank through Synapse. 3 layers. Explainable in one sentence. Except in one crucial way, it wasn't 3 parties. It was one company holding the only record of which slice of that pooled money belonged to which one of you. Evolve wasn't a stranger to scrutiny either. Examiners had already been circling its risk management practices by 2023, a full year before anyone outside the industry had heard Synapse's name. Here's what none of that scrutiny caught in time. Nobody outside Synapse could actually verify whose money was whose. Not the banks, not the apps, not, as it turned out, anyone at all. That single fact, the one company that held the master list, is where this story actually starts. So how, exactly, did one company end up the sole keeper of a ledger worth $250 million? That's the method. In November 2022, an Evolve Bank controller noticed something wrong. The numbers weren't matching. By what he called a couple $100 million on the daily. Partner banks held customer money in FBO accounts, for benefit of one pooled account holding thousands of people's deposits, with the bank required to track only the total. Who owned which dollar inside that pool? That question belonged entirely to Synapse's internal ledger. Not the banks, not the apps, only Synapse's. If Synapse's number was wrong, there was no second copy to check it against. Synapse called this modular banking, splitting one fintech partner's deposits and withdrawals across multiple banks, marketed as a reliability feature. It was also structurally the exact mechanism that would make the money impossible to trace later. Yada, one of the bigger apps in the network, had told customers as early as 2021 they could win up to $10 million by saving in an FDIC-insured account. When customers later asked the FDIC directly whether their money was actually covered, the real answer was less reassuring. The short answer is, it depends. The warnings kept coming. In October 2023, Pathak himself told partners the company needed more resources devoted to reconciliation. 7 months before the collapse, the man running Synapse was asking anyone, to look closer at the books. Nobody did, with one exception: money, and the money had moved first. A month earlier, on September 27, 2023, Mercury and Evolve moved more than $3 billion out of Synapse's FBO accounts and into accounts they controlled directly. The two best-resourced partners in the network protected themselves 7 months before smaller apps, and their customers got the same chance. By early 2024, Synapse had reportedly moved $60 million in end-user deposits to cover a reserve shortfall it owed one of its own partner banks, funds the bank moved fast to wall off once it noticed. If the method sounds like a system built for nobody to be fully responsible, wait until you see the result. On April 22, 2024, Synapse Financial Technologies filed for Chapter 11 bankruptcy. Within 3 weeks, the company had let go nearly its entire staff and cut off the technology partner banks needed to process transactions. On May 11th, withdrawals stopped. Debit cards stopped working. More than 100,000 people across dozens of apps were locked out, $265 million frozen. 1 month later, on June 6, 2024, the newly appointed trustee filed her first status report. Partner banks were physically holding about $180 million. Depositors were legally owed $265 million. Somewhere in that gap sat between $60 and $95 million. The range moved depending on which report you read, itself the point, that nobody could locate. Not the trustee, not the banks, not the company that built the ledger, because that company had already fired everyone who understood it. Separately, the CFPB opened its own case, not for theft, but for a Consumer Financial Protection Act violation, failing to keep records that matched what partner banks actually held. Systemic failure, not a specific crime. That distinction matters, and it's about to matter a lot more. Before I go further, the strongest counterargument deserves real airtime, twice. First, maybe this isn't structural at all. Maybe it's simple. Synapse had one job: keep an accurate ledger, and failed at it. Partner banks reasonably trusted their vendor to do the one thing it was hired to do. That's not a design flaw. That's a company failing its own basic function. Except the Federal Reserve's own cease and desist order against Evolve, issued weeks after the collapse, found Evolve itself lacked, quote, an effective risk management framework for exactly this kind of dependency. Evolve had no way to check its most important vendor's homework. That's not one company's failure. It's a structure nobody was required to verify. Second, stronger counterargument. This system did produce accountability. FINRA charged 2 named executives, Jeffrey Stanley, Synapse Brokerage's former president, and Mark Paverman, its former compliance chief. Paverman settled, a year-long suspension, a $20,000 fine, admitting nothing. Stanley denies the allegations and is still contesting them. The CFPB extracted a judgment and has allocated over $46 million. Federal grand jury is still investigating. 4 separate enforcement tracks running in parallel. That's not nothing. It's also not the $85 million. The CFPB's own penalty was $1. Paverman's fine was $20,000. The grand jury, after 18 months, has produced a subpoena, not an indictment. 4 tracks, and not one of them ends with the missing money coming back. Motion isn't the same as resolution. That's the whole case in one sentence. That's the public record. But the public record has gaps of its own, starting with what one company already claimed was finished. Evolve Bank spent much of 2024 promising it was completed reconciliation. By October, it announced exactly that. According to later reporting, what it didn't advertise was that the reconciliation had only calculated balances at Evolve itself. 3 other partner banks, Lineage, AMG National Trust, American Bank, weren't part of that math. Complete meant complete for roughly 1/4 of the picture. That gap between promise and record wasn't new. Apps in the network had spent years telling customers their money was, in one company's words, safe and FDIC-insured, and that customers simply can't lose it. California's financial regulator eventually agreed that was false. More on that in a moment. Evolve also brought in outside help to untangle the mess, including one of Synapse's own co-founders, hired back to help reconstruct the very system his own company had built. At the top of this video, I told you Kayla Morris recovered $500 of the $280,000 she put in. Here's the context that number needed. Her funds sat in one of the accounts Synapse's ledger couldn't cleanly match to a bank record. Not flagged as fraud. Not flagged as stolen. Just unreconcilable. "We're not gamblers," she told reporters. "I never would have put a penny in if we had known there was any risk involved." She wasn't alone. Joseph Dominguez in Sacramento told the bankruptcy court he had more than $20,000 frozen, writing that he didn't know where his direct deposit had gone or where his pending withdrawals were being held. Chris Buckler, a Maryland schoolteacher, had nearly $38,000 locked up. Years of saving, gone in a weekend. Now, the number that changes how you see everything else. Jelena McWilliams spent 18 months as trustee. She tried to sell Synapse's remaining assets to a company called TabaPay. The second time that exact deal had collapsed, after an earlier version fell apart within weeks of the original bankruptcy filing. Twice, a rescue buyer walked away because nobody could agree on who owed whom. So in June 2025, McWilliams did something you rarely see from a bankruptcy trustee. She asked the court to dismiss her own case. Not because it was solved, because there was nothing left to spend investigating it. On November 13th, Judge Martin Barash granted the motion. On the record, he said this: "I don't know whose fault that is, but it's clear there's a problem. If a moment like that is why you watch this channel, this is exactly the kind of story we go looking for. Subscribe and we'll keep finding them." The FDIC's own former chair had 18 months, a top law firm, and full subpoena power. She still couldn't produce a villain. That's not a failure of investigation. That's the system doing exactly what it was built to do. 18 months of looking produced one honest sentence: nobody knows. But if you know what to look for, you can spot this recipe before you ever hand over a deposit. 3 signs. Here's the first one, and it goes back to the ingredients. Count the companies between the app on your phone and the FDIC-insured bank underneath it. Synapse sat between you and Evolve. If you can't name every layer, neither can they when something breaks. Sign 2. Back to the method. Ask who actually holds the ledger. If one private company is the sole record of what's yours, not the bank, not the app, just a database only they can read, you don't have a bank account. You have a claim filed with a company that might not answer the phone tomorrow. Sign 3. Back to the result. Watch what regulators actually punish. California fined Yada $1 million in 2026 for the marketing claim, the words FDIC-insured on a homepage. Nobody has been fined $1 for the $85 million that's actually gone. The system polices what companies say far more aggressively than what happens to your money after they say it. Put those 3 signs together and here's the pattern. You're not looking for a villain. You're looking for the number of steps between your money and the word insured. The more steps, the less that word means. Kayla Morris still checks her account balance sometimes. It still says $500. Jelena McWilliams stopped hunting for the missing millions. In January 2026, she joined Plaid, another company that sits between your bank and the apps you use, this time as president of corporate and external affairs. Same industry, same seat at the table between you and your money. Just a different chair. If this recipe changed how you look at the app on your phone, that's exactly why this channel exists. Subscribe, and next week we'll open another kitchen most people never get to see. Today's recipe, complete. So, what business should we crack open next? Drop the company name in the comments. We read them. If you want more case studies like this one, subscribe. New recipe every Tuesday.